This is our mid-year hangout, or just an update of kind of what the outlook is economic-wise. So we have Ross Thayer from U.S. Bank. He's going to give us a presentation on his outlook and answer any questions that the group has. So go ahead and take it, Ross.
First thing that I have to do is eat crow from our last one, where I told everybody that interest rates are going to be coming down in May. And all of the information that I based that on, the inflation data has been stepping down progressively, but I did not predict the banking crisis. And that's, definitely threw a wild card in it, but it's something maybe that I should have been on the lookout for. But with anything, you learn more from your mistakes than you do from what you did. I learned more what I did wrong than I do from what I did right. So with that, and I just put one page on what happened in the banking crisis in a nutshell, because people think, oh, just banks went out of business. But why did they go out of business? And it was primarily because they had 10 years of the banks lend money. They will borrow short term and they'll lend it long term. So they'll borrow for overnight, they'll borrow for a week, for 30 days, for 60 days, they'll tier it, but it's all short-term borrowing. And so, what you were getting on your checking account, you were getting zero on your checking accounts, and they were borrowing from the Fed at zero. So all of these years, they were making loans at 2%, 3%, 3.5%. And that was fine. They were making money. But then all of a sudden, their short-term borrowing went up to 5%. And think of it this way: if you had to borrow money at 5% and you were lending it out at 2%, you're losing money. So they got into a crunch of they were losing money. And yes, they were making money on the new loans that they were making, but they really couldn't make those new loans, even though they wanted to at 6 or 7%. They couldn't make them because they needed to raise cash to pay for these losses that they had. So it was kind of a catch-22 where they couldn't make the loans and make the higher interest rate because they needed to save the cash to pay the losses they had over here. That's still shaking out, but most everybody's kind of got it in order now. And I know from a U.S. Bank perspective, what I've been told is they need to get to a 9% capital ratio, meaning they have to 9% of their assets they have to have in cash. And they were getting up close to that number, but then they bought Union Bank. So that dropped their capital ratios back down because Union Bank had a lot of portfolio loans. They were doing a lot of the interest-only loans, as we all know in the industry. And so that dropped them back to about 7.5 or 8. So they'll get back up to 9. And soundness-wise, they're perfectly fine, but they do have to just be more conservative in their lending out there. With that said, California is still a primary market for them, and they really want to grow their footprint. So they may have cut back in other avenues, like I believe they said they cut out commercial lending, but I still have had no problem funding the jumbo loans, albeit the interest rates are higher, no doubt, but we're still able to make those loans. So in the long run, this will all work out, but that's kind of what happened. Like everything, you average everything out. So if your cost of money is 5, but you've got some loans at 6 or 7, some loans at 2 or 3, it all kind of averages out. So it'll all play out in the long run. As we all know, the big banks always are very well capitalized. It's a rigged system, but they'll come out just fine. The smaller community banks, I do still think will have some trouble because there's a lot of commercial businesses that, even though they're probably working and doing fine, people know those commercial loans always have to be renewed every 3 years to 5 years. So commercial businesses have to renew those loans. And even if they can renew, it's going to jump, their rate's going to jump from maybe 3 or 4. So that'll, affect their profits. And it also might be a function of if the banks aren't willing to make those loans, like we're not making any commercial loans, they could be a great paying customer, but banks says, no, we're not doing that business anymore. Most of those small loans are held in the small local banks. So I think there will be some pain points there, but all of that should, help to actually the flip side of it is it will help to keep inflation down because it will reduce activity. I said at the beginning how the inflation numbers have started coming down. And again, the inflation peaked at like 9.25 or something like that in like April of 2021. And then it kind of rode up in that 8 to 9 range. And that's why the Fed got all worried and bent out of shape and started raising rates. Well, since December, January, those year-over-year comparisons have all been stepping down every month, just stepping down a little more. And the latest numbers today for CPI the headline CPI came in at 1.8%, that's actually below the Fed's target of the 2%. My personal prediction is that they're probably going to start creeping down towards the end of the year, but they won't really come down to where I think the low of the rates will be until early to mid 2025. I do believe the Fed is near the end of their cycle. I do believe that they'll do 0.25% at the next meeting, which is what, the 26th or something like that. I do believe they'll do a quarter here and at least another quarter after that.
Okay.
So at that point, the market is feeling that the Fed is almost done. So overall, that's where we may see some easing, although it won't be down to the full amount. I think it may be creeping down into the high fives maybe next year. But I think they're really, until that inflation really, until you see headline and core and all of these things getting down, they want it to be below 2%. I do expect the Fed to raise at least the one more quarter. I mentioned that. And then I think they'll raise at least one more quarter after that. They're acknowledging now that they're seeing, the slowdown from the result of all of their things. It's been drastically slower for us, and it's a function of less transactions. The prices are still going up, but they did have a lull there actually from May, June of 2022 to May, June of this year. We had like 19% in 2020 and 20% in 2021. So to give back 3%, I'm not going to complain. I don't even know that we saw that much because we're already back higher. Housing cost makes up 43% of CPI. That's going to also work against us in keeping the inflation up, which makes me feel it's going to take longer for this to all work out.
So people are able to get loans though, which was what I was reading was harder for people to get a loan. Now banks and lenders were being pickier about who they lent their money to because they could.
Right. I haven't experienced pickier yet, but the rates are definitely up there. And that might be just a US bank thing. I know, another bank that has stagecoaches and stuff. They said they weren't lending to anyone other than their customers. So that's a serious pulling back from the market. And I've heard others say that they're pulling back from the market, knock on wood. We're not necessarily pulling back from the market. We're still making the loans. And I haven't seen I'm still getting exceptions for stuff that is pretty unique. Just the rates are 6 3/4 or 7, it's a higher rate. So homeowners insurance is tougher to get. I'm telling my clients to start looking into it right away. I had a client recently that owns 2 other properties. He went to his insurance company and they said, oh, we can't write the policy on that. He had to go to a total another, and this is a company he's been doing business with. So, but although it's the same issue in our industry, it's not related directly to the lending side of things. So the getting of the loans we can do. And then it kind of flipped here in the last 5 years where jumbo loans were actually cheaper than agency loans. Now it's kind of back to where jumbo loans are priced higher than agency loans. And the banks will make agency loans all day long because they can sell them off to Fannie Mae. It's just a net profit. It's a product they're selling, and then they're going to keep the servicing and they're going to make annual income on the servicing, but they can sell off the loan right away and make instant profit. So there's no reason that those loans would be tougher to get. The biggest problem we have is inventory. There just aren't enough transactions out there compared to, what we're used to doing. And I personally, I think that's just going to get worse down the road because who wants to get rid of a 2 or 3% mortgage unless you're getting divorced, unless you die, unless you've been transferred for work, and you can't keep your house. And, even I know people who've gotten transferred and they kept the house because they had, a 3% or 2 3/4 mortgage. And they said, well, I can rent it out and I don't want to get rid of that mortgage. I'll rent this one and go rent in Texas or wherever they're being transferred to. I've had several clients do that, which, doesn't help the inventory side of things. That's really our dilemma, right? Is it just aren't enough homes to sell. You've got buyers who would buy them, if we had more homes to sell. So, and that's part of why our prices are still going up. It really isn't being affected by those things. At some point it reaches a point where people can't afford it anymore. And maybe that will bring the ratio more into balance, but it's not going to bring more homes on the market, which is really what we need. I think I kind of covered a lot of this stuff in my rambling. I think the market's going to remain strong, and this inventory is the issue more than anything. There's plenty of buyers, in my opinion. I have done the math on numbers. Let me make sure I didn't miss anything on this screen. Qualifying is beginning to limit some people. I have some buyers that are falling, that the prices are getting up beyond what they can qualify or get the loans for. And I know some people are beginning to get squeezed by that, but it still hasn't been a major impact. Again, it's inventory is the issue. But I think if houses just went up 5%, that's 50 grand. Right. That's 50 grand in a year. So it'd be 75 grand in a year and a half, in theory. So if you're paying, would you rather pay 7% and pay an extra 9 grand in interest, or would you rather wait until, 18 months from now and pay, 50,000 more? No, I'd rather buy now. You can always refinance, which then brings me to the question I'm talking to a lot of people about now. And that is, when you go to refinance, the basic cost to refinance is about 4 grand. Then that goes into my sales pitch stuff, which I won't bore you guys with the details, other than that we can lend in all 50 states, and, I can do refinance or purchases. We don't do reverse mortgages, but we do construction for owner occupied, which is something a lot of people don't quite realize. We do not do construction for builders that are building a spec home, but if you're buying a lot that you want to build on, U.S. Bank will do that loan, and they'll give you a guaranteed takeout loan on it. What a takeout loan means is when you finish the construction, that most construction loans are 1 to 1.5 years that they give you to do the construction. Yeah. And then the takeout, so they guarantee that they'll give you a takeout loan on the back end, meaning that they'll give you a 30-year fixed rate but it's an adjustable rate loan tied to prime. But say if the going rate on a 30-year fixed is, let's just say 7%, your takeout loan might be 7.5%.
Sure.
What they'll guarantee you down the road, because they don't know what rates will be in a year and a half from now. So they're giving you a commitment right now of what they will lend.
So my next and final question is, have you joined Threads yet from Facebook?
I have not. I don't even have Twitter. So
Yeah, you do it from Instagram. So I'm just kind of curious. That's the newest so more social.
It is. They got to 100 million users in 24 hours or something like that. Or
it was really easy to sign up. I haven't signed up, but I'm so done with social media. It's just feels like it rots your brain. Worse than drinking.
Yeah. Yes. I'm not on Twitter and I'm not on Threads, so I'm a bad person to ask for that.
All right. Well, hey, we appreciate you taking your time. This has been recorded. So what we're going to do is we're going to pass this out. And then that phrase is, you date the rate, you marry the house.
There you go. What did I say? Did I reverse it?
You did something else. I don't know what you said, but it wasn't dating the rate. That's what we use when the interest rates are where they're at, because you can always refinance as
Thank you for in the heat of the moment. I couldn't remember the.
No, that's fine. You're on a roll. I didn't want to interrupt you. All right.
Thanks, guys.
All right. Thank you much. Y'all have a good one. If you're wondering, in Las Vegas, it's 109 degrees right now where I'm at.
Nice and cool.
I know it is, and it's 97 at night. So that's the desert, and there's wind. So I always describe it as just think of a big hair dryer blowing it.
Yeah, and you can get sandblasted.
Yeah.
Great.
All right, guys. See y'all later. Take care.
Bye.
Bye.
Thank you, guys. Sorry for the ramble.